Our Forex presentation today. It is Monday, the 8th of February, 2021, 11:22 a.m. Eastern Standard Time. I want to go over something that's been requested before on the COT report, or the Cot Report, Commitment of Traders. So the Commitment of Traders report is a weekly report done by the CFTC in the United States here, the Commodities Futures and Trade Commission. And essentially what it is, it's showing you on a Friday. So last Friday, it's showing you the data of Tuesday, that prior Tuesday. So on Friday, this Friday, we will get to see what happens tomorrow on Tuesday. And what it's showing is basically the open interest of an instrument that has a futures contract. And open interest is just another word for how many existing current long positions and short positions exist. So for example, this is the Australian dollar. This is telling us for non-commercial, commercial, and non-reportable. And you don't have to worry about actually, let me say this. The one that you want to look at and notice is non-commercial. All right, that's this middle column here, and this is not the actual report. If you want, you can go to the CFTC's website, and their report is all text data. It's not. It doesn't have a nice graphical interface. There's a lot of free sites that provide this info for free in a really much easier way to read. Non-commercials are the players you want to pay attention to, because non-commercials are your excuse me, hedge funds, banks, well, not really banks, but hedge funds, speculative traders, trading desks. I mean, this is where the professional foreign currency and futures trading money is at. And so it's best to follow what these guys are doing, but they also fall prey to things that retail traders do. Non-reportables are, that's you and me. That's all of us who do not work for a trading desk. We do not work for a private hedge fund. It's just, these are all retail positions. Commercial is something you don't really have to worry about. Commercials are okay, let's say I lived in Great Britain and I was buying auto parts from a company in Mexico, but I also employed some people in Mexico. I would hire some type of company that focused on keeping my labor costs and my and the costs of the goods that I need, making sure that those costs stay relatively stable so that they're not overly influenced by currency fluctuations, because you don't want to have to pay 5 or 6% more this month as you did last month. So commercials are always trying to really like hedge positions for business and businesses. Non-commercials, they are the professional speculators. And so when I'm looking at the Australian dollar, and actually the question is, how does this help you? Because this helps us because we get to see where people are at and what they're doing, and it provides trade opportunities. So this is the Australian dollar. What do I see here? I really don't see a lot of opportunity. Why? Because we have pretty much a 50-50 split between longs and shorts. So professionals are split 50-50 on the long and short side of the market. The changes below, so if you look at the non-commercial, long and short, it is telling us that there were 604 contracts taken off of the long side of the market, while there were 1,600 contracts added to the short side of the market. That itself is not anything really telling, because we haven't seen a huge change in the percentage of long or short. So we really don't have to look at that. I mean, I look at this middle column, and that's all I really want to know. And then I look over here to see if there's anything drastic between the changes in the longs and shorts for non-commercials and anything drastic between the non-reportables. What you're often going to see, and this is kind of one of the maxims that exists in trading, period, but here you get to see visual data proving it, is that retail traders generally do the opposite of what what non-commercial or professional speculators are doing. All right. While prices are going up and reaching new highs for over 45, 90 days, you have a whole bunch of new traders entering at the top of that market, while professionals are scaling back and starting to add short positions. The British pound. kind of the same story. We're pretty split here. I mean, 54% long versus 45% short. And we've had, 6,300 contracts added to the long side and 4,600 added to the short side. Not a whole lot of anything to really look at there. Canadian dollar, same story. I mean, it's definitely 60% long versus 40% short, and retail traders are 70% long versus 30% short. But what you should notice is that there was a lot of short positions taken off, almost 9,300 contracts taken off of the shorts. In a nutshell, I really don't see a whole lot of trading opportunity here either. Now, the euro, on the other hand, this looks like a fun trading opportunity. Why? Because look at the ratio. 73% of these professional speculators are long versus 26% who are short. We have a pretty similar ratio for retail traders. They are 68% long versus 31% short. But then look at what happened last week. Right here, this is the big deal. We have negative 21,000 contracts taken off of the long side of the market, and then we have 7,100 shorts added. That's a big difference. So we saw a reduction of over 10% of the active long position, so meaning that professionals sold or took profit. And then further, 7,100 people added to the short side. Retail traders did a lot of the same thing. We had 21 people went long, or rather 21 contracts, doesn't mean 21 people. 21 contracts long versus 3,500 added short. So there's a lot of shorts added in retail and non-commercials, with longs being reduced by a huge amount by professional money, which says that the euro has a nice trip to the south coming up. That's how I read this. When you see this imbalance, I know a lot of people say do what the big players are doing, which you should, but pay attention to this, because when 73% of the professional money is long, I like to trade against that, because that to me says that's too far, that's too much, that's too much exposure. And why do I do that? Well, just think about it this way. If everybody's long on the euro and prices go up, who gets hurt the most? The shorts. But there's not a lot of shorts to get hurt. However, if the euro starts to crash and move south, how many people are affected by that? How many of the participants are affected by the euro dropping versus the euro going up? There's a lot more people who are going to be hurt by the euro going down than it will be going up. And so that's why I like the short play. Japanese yen, pretty much the exact same thing as far as the play here. But you do see a greater discrepancy between the professional money, non-commercial versus the retail traders. And we had pretty equal distribution of longs and shorts added, but notice this. Retail traders took away 8,600 contracts. They added 6,800 contracts to the short. 8,600 removed from longs, and they added 6,800 to the shorts. But then non-commercials, pretty equal distribution. 6,100 added to longs and 6,500 added to shorts. I like the weakness of the yen here. I think the yen gets weaker, meaning the USD JPY, the GBP JPY, we should see those rocket up, and we should see all of those yen pairs move really high. We should see the yen index fall down south. Swiss franc, very much the same thing in the distribution here. So this is one of the things you always want to see that's really nice, is that non-reportable traders, they exited longs by 2,700 contracts, but then professionals added 4,500 contracts. Only 28 exited shorts, but there was a lot more. There was a ton, like a 20% addition to the existing long contracts for the Swiss. So we should expect to see the Swissy. I think the Swissy gets weaker. Why? Because 75%. What's the threshold? I look at anything greater than 70% is overdone to me. So just like the yen, I would expect to see the USD CHF move up, the pound Swiss move up, and maybe not the Euro Swiss because of all the selling in the euro, but definitely, pairs that look like they're gaining strength and those that look like they're losing, you can really get a good idea of that with the COT report. U.S. dollar, going long in the U.S. dollar seems like a pretty good idea because of how close this ratio was heavier, but I mean, otherwise it's pretty equal distribution of longs and shorts added. And then the Kiwi dollar, you had 23 contracts added to the long side versus 5,400 to the short. That's a difference. That's a huge difference. There's 18,000. If we can actually look at historical data, so we can look at last week's report. There were 13,000 short contracts open on the Kiwi dollar. Fast forward to now, that's a lot. I don't know, is that a little over 30% increase in shorts? Expect the Kiwi dollar to fall down. That's what that reads to me, is that we should see weakness in the Kiwi dollar, which we did kind of see reflected in the price action last week. And then Bitcoin, Bitcoin futures, but then look at the stock market, specifically the Nasdaq. So these are the Nasdaq futures, the NQ. Now, when I look at this and I see this discrepancy, I get giddy. So I am big time short on the Nasdaq. I added like 10 short contracts between the close of the market yesterday, or not, on Friday, and then until roughly about 10 minutes before I did this video. So I've got 10 contracts short on the Nasdaq. Why would you do that? Why? It's moving up to new all-time highs. I'll tell you why. And it has to do with this huge imbalance. So this is a pretty good imbalance of 60 to 40% in the Nasdaq, but that's not the point. Look at the non-reportables. Look at what retail traders did. They added 4,500 contracts to the long side of the market, and then they exited shorts by 2,800. That is the exact reverse of what's happening over here with professional money. Professionals took profit. They took money off the table, but what else did they do? They packed on almost 10,000 short contracts. 10,000 short contracts. That's huge. There is a ton of professional money that is now expecting the Nasdaq to go down. That is the direction that I want to be on. When you see this right here, you see 4,500 long contracts by dumb money, as we're affectionately called, versus smart money. 4,500 added to the long versus the smart money reducing their longs, taking profit, and then adding massive amounts to the short side of the market. That's the kind of the side of the market you want to be on. And so the COT report, very, very, very powerful tool, very, very useful. But you need to be careful in how you interpret it. Look for major imbalances. Otherwise, if you look at it and there doesn't seem to be a whole lot there probably isn't. So don't try to find it. But if you see things like this, you have these huge differences. But if you see retail traders are adding to the market by buying it up, but you see professionals are shorting it by large amounts, that's something to pay attention to. But if you see something like this here in the middle, the non-commercial, it's like 50-50. That you probably won't see a whole lot of trading opportunities. You just want to look for those major imbalances and go with that. So anyways, y'all have a good rest of your trade day. Take care of yourselves. Have a good start to your week. From all of us here at Exchange Rates UK TV, please don't forget to like and subscribe. Thank you.